Hi there. Welcome to session 11 of this financial accounting course where we'll be focusing entirely on the statement of cash flows. This statement is crucial because it answers the critical question, where did the company's actual cash really come from and where did it go? Net income is important, but as some Wall Street analysts say, cash flow is king. By the end of this session, you'll be able to classify cash flows into the three main activities and master the reconciliation process of the indirect method. Our roadmap for this session is clear. First, we'll cover the three main sections of the statement, which is operating, investing, and financing activities. We'll focus heavily on the operating activities section as it's the most complex, and we'll concentrate on the indirect method used by most companies. Finally, we'll look at how to complete the full statement and review the required additional disclosures that accompany it. This session will ensure that you can not only classify cash flows, but also understand the core logic behind the entire financial statement. Alright, this slide illustrates the fundamental conflict that makes the statement of cash flows necessary. The figure on the left is the basis for your net income. The accrual basis of accounting. Revenues are recorded when they are earned and expenses are recorded when they are incurred or matched to those revenues. The figure on the right represents cash basis. Recording revenues only when cash is received and expenses only when cash is paid. Because of this timing difference, net income rarely equals to net cash flow. As a consequence, analysts must consider the information provided in the cash flow statement in addition to the income statement and the balance sheet. The entire purpose of the statement of cash flows is to bridge this gap and reconcile the accrual-based net income back to the true net cash flow. Alright, we'll begin by looking at the fundamental structure of the statement of cash flows. The entire report is organized around three broad categories of business activity: operating, investing, and financing. The first section is cash flows from operating activities. These are the inflows and outflows directly related to earning income from the company's normal business operations. This is our most critical section as it reveals the cash generated internally. The second section is the cash flow from investing activities. This tracks cash related to the purchase or sale of long-lived productive assets like property, plant, and equipment, and also investments in other companies. The third section is cash flows from financing activities. This includes cash exchanges with external providers of capital, our creditors and our owners. We total these three sections to get the net change in cash. When we add this net change to the cash balance from the beginning of the year, the sum must equal to the cash at the end of the year. Alright, now that we've established the overall structure, let's zoom in on the cash flows from operating activities section. As you can see, this is the most involved section because it's where the indirect method reconciliation takes place. We start with net income and then make various adjustments for non-cash items and changes in operating assets and liabilities. We also see the components of the direct method, which reports actual cash receipts from customers and interest, and gross cash payments for suppliers, wages, and other expenses. Both of these methods ultimately arrive at the same final number, but the indirect method's reconciliation is what we'll focus on, as it's used by almost all US-based companies. Our goal in this session is not just to know the final number, but to understand the logic of the adjustments used in the indirect method. Alright, let's move on to the second section of the statement of cash flows, investing activities. This section tracks cash related to the acquisition and disposal of two main types of assets: long-lived productive assets, and investments in the securities of other companies. Look at the inflows on the left. These are generated primarily from the sale of plant, property, and equipment, and the sale or maturity of investment securities. On the right, the outflows are generated by purchases. These include cash paid for the purchase of new PPE or plant, property, and equipment, and the purchase of investment securities. Investing cash flows show management's strategy regarding capital expenditures and portfolio allocation, answering the question, is the company adequately investing in its future productive capacity? Alright, let's move to the final of the three core sections, cash flows from financing activities. This section is crucial because it tracks cash exchanges with external providers of capital, our creditors and our owners. Okay. On the left, our inflows are generated from borrowing cash by issuing bonds, notes or mortgages and from issuing stock to owners. Okay. On the right, the outflows show the cash used to service or adjust our capital structure. Okay. These include repayment of loan principal to creditors or repurchasing the company's stock and paying dividends to our owners. Okay. The primary purpose of this section is to show analysts how management has elected to fund its growth and how it manages the balance of debt and equity. Alright, before we look at the three core sections in detail, let's establish the crucial mathematical link between the balance sheet and the statement of cash flows. Okay, understanding this is the groundwork for why the indirect method works. Okay, we begin with the fundamental accounting equation, which is assets is equal to liabilities and stockholders' equity. Okay, this is the balance sheet equation. Okay, we then logically split the assets into two parts. Okay, we're just trying to separate cash. So we separate it into cash and non-cash assets. Okay, everything other than cash. Okay, if we rearrange the equation, we can isolate cash on one side. Okay, so cash is equal to liabilities plus stockholders' equity minus non-cash assets. Okay, the final step and the most important is recognizing that this relationship holds true for any change that occurs over a period of time. Okay. A change in cash for a period in time should equal to a change in liabilities plus a change in stockholders' equity minus a change in non-cash assets. Okay. This equation proves that any change in cash must be explained by a corresponding change in the other balance sheet accounts. Okay. This is the exact logic the indirect method follows to reconcile net income, which is already reflected in retained earnings, with the final cash balance. Alright, we're building on the foundation we established in the previous slide. We know that any change in cash must be explained by a change in the other balance sheet accounts. Okay, this slide shows a comparative balance sheet and how every non-cash account is categorized for the statement of cash flows. Okay, on the left, under related cash flow section, you can see these classifications. Okay, O stands for operating, I for investing, and F for financing. Okay. Notice that all working capital accounts like accounts receivable, inventories, accounts payable, okay, are marked with an O. Okay, we use the change in these accounts to reconcile net income to cash flow from operations. Okay, investing activities or I, okay, relates to long-term assets, primarily plant, property and equipment, and short-term investments. Okay, note that for net PPE, its primary cash flows, purchases and sales, or investing, but the depreciation component is used in the operating calculation and therefore it links to both sections. Okay. Financing activities, or F in our column, okay, relates to external capital, contributed capital and retained earnings, specifically for the dividends paid. Okay. Retained earnings is also impacted by operating activities through net income. Okay. This classification is essential. Okay, once you know which section a change belongs to, you're halfway to solving the statement. All right, we're now shifting our focus entirely to the cash flows from operating activities section. Okay, this section is without a doubt the most important section of the entire statement, as it details the cash inflows and outflows directly related to earning income from the company's core business operations. As we established, we will be focusing on the indirect method, okay, the required method for reconciliation, which converts that accrual figure of net income back into a true cash flow figure. Okay, since this section is the most critical and complex, okay, we're going to be spending quite some time on this to understand its inner workings and the logic behind every single adjustment. Now that we know the indirect method is a reconciliation, let's look at the step-by-step roadmap we'll follow to convert net income into cash flow. Think of the slide as a checklist for any problem you solve. Okay, we begin logically with step 1. Okay, you start with net income from the income statement. This is our starting point for the entire reconciliation. Next, we handle the non-cash timing issues. Step 2 involves adjusting for non-cash expenses like depreciation and amortization. We'll soon see in detail why we add them back. Step 3 is adjusting for non-operating gains and losses. specifically those related to selling long-term assets. Okay, we'll break down the logic of adding or subtracting to ensure we don't double count cash flow that actually belongs in the cash flow from investing activities section. Okay. Finally, the bulk of the work is in adjusting for changes in working capital accounts. Step 4 is where we apply the inverse rule to all changes in operating assets. And step 5 is where we apply the direct rule to all changes in operating liabilities. After performing all 5 adjustments, the final result is our net cash flow from operating activities. Let's now walk through the steps and look at them in detail. We are now beginning our reconciliation process, starting with the first 2 actions on our roadmap. Okay, step 1 is simple. We start with net income, shown here as our bottom line, right? This figure should be converted to a cash flow number. Okay, step 2 is our first critical adjustment, dealing with non-cash expenses like depreciation and amortization. Okay, look at the income statement snippet here. Okay, we subtracted $10,000 for depreciation along the way in our calculation of net income, right? Okay, this reduction is what we need to reverse now. Okay, the logic behind this is the following, right? This depreciation expense reduced our net income, but it did not reduce our cash. The cash was spent years ago when the asset was actually purchased. Okay, to reverse the non-cash reduction and find the true cash flow, we must add it back to net income. Okay, a quick side note on taxes if you're concerned. While depreciation did reduce our taxable income and therefore reduce the cash we paid for taxes, okay, that effect is already accounted for within the income tax expense line. Okay, for the purpose of this simple adjustment, we just focus on the non-cash nature of the depreciation itself and perform the full add back. Okay, the simple rule remains that if it was a non-cash expense, you add it back. Okay, our next adjustment, which is step 3, deals with gains and losses on the sale of long-term assets. Okay, let's use a numerical example again to figure out the why. Okay, we make these adjustments primarily to prevent double counting the cash flow. If a machine with a book value of $6,000 is sold for $8,000, let's say, we recognize a $2,000 gain. Okay, this gain increased our net income, which is our starting point, right? Okay. Since the $8,000 in cash is already counted in the cash flow from investing activities section, and only $2,000 of that is inflating our net income, we must subtract the $2,000 gain from the net income in the operating section, okay, in the cash flow from operating activities section. This removes the non-operating revenue, okay. The opposite logic applies to a loss on a sale, okay. If the machine had sold for less than $6,000, then the resulting loss would have decreased net income. To reverse that negative non-operating effect, we would add the loss back. Okay, we are essentially ensuring that net income only reflects operating items before we move to the final adjustments. Now we move on to steps 4 and 5, which is where we deal with changes in our current operating assets and liabilities, also known as working capital accounts. Okay. Step 4 of our roadmap deals with adjusting for changes in our operating assets. Let's jump straight into an example using accounts receivable to figure out the rule. Okay, this is the logic behind the inverse adjustment. Imagine our accounts receivable started the year at $1,500 and ended at $1,000. Okay, our income statement reported $40,000 in sales revenue. Okay, our accounts receivable decreased by $500. Now ask yourself, if accounts receivable went down, did we collect more or less cash than the revenue we reported? A decrease in accounts receivable signals that we collected $500 more cash from customers than the sales revenue we reported on the income statement. Okay, since net income already includes the $40,000 revenue, okay, we only need to account for that $500 difference. Okay, because we collected more cash, that $500 must be an increase in cash flow. Therefore, we add the $500 decrease in accounts receivable to the net income. This leads us to the fundamental rule for all operating assets. The relationship is inverse. Okay, if an asset balance increases, we subtract that amount from net income. And if an asset balance decreases, we add that amount back. This inverse rule applies to all key operating assets: accounts receivable, inventory, and prepaid expenses. Okay. Now take a moment to apply the same thought process to the other items. If inventory increases, Does that mean we paid more cash or less cash than the cost of goods sold reported? Think about that as we look at the next set of adjustments. Now we look at the final part of our reconciliation, step 5, dealing with operating liabilities. The relationship here is the opposite of assets. The rule is direct. Okay, let's jump into the accounts payable example to understand why this relationship is direct. Imagine our accounts payable started the year at $1,500 and ended at $1,000. Okay, the relevant accrual expense, let's say, was $20,000. So our accounts payable decreased by $500. A decrease in accounts payable signals that we used $500 more cash to pay down our balances than the new expenses we incurred during this period. Okay, essentially we had an extra cash outflow. Since net income has already been reduced by that $20,000 expense and we paid $500 extra cash now that wasn't reflected in that expense, we must subtract the $500 decrease in accounts payable from net income. This leads us to the fundamental rule for all operating liabilities. The relationship is direct. If a liability balance increases, we add that increase back to net income. And if a liability balance decreases, we subtract that decrease. This direct rule applies to key operating liabilities like accounts payable and accrued expenses. We have reached the end of the reconciliation process. This slide brings together everything we've covered into one powerful summary table that you can use as a reference tool. Okay, as you look at the table, notice the clear logic. The entire method boils down to reversing the distortions caused by accrual accounting. The non-cash items like depreciation and losses on sale are added back because they reduce net income but not cash. The non-operating items like gains on sale are subtracted because the cash is counted elsewhere. And most importantly, look at the working capital accounts. Remember the two rules: assets are inverse and liabilities are direct. Okay, if an asset increases, you subtract that increase because an asset increase means you recorded more revenue than you collected in cash. If a liability increases, you add that increase because a liability increase means you recorded an expense but paid less cash than that expense. On a side note, instead of looking at individual assets and liabilities, you can also view this process through the lens of working capital. Okay, remember that working capital equals current assets minus current liabilities. Okay, you can calculate the change in working capital first and then apply a single simple rule. If working capital increases, which happens when assets increase or liabilities decrease, it means cash was used or tied up. Therefore, you subtract the increase from net income. If working capitals decrease, which happens when assets decrease or liabilities increase, it means cash was freed up. Therefore, you add the decrease back to net income. This working capital approach is an advanced analytical technique, but it confirms the logic of our individual rules, right? So when you approach a cash flow statement problem with this mindset, understanding the why, you won't have to memorize a single rule. Okay, you can derive the adjustment every single time. This final result, the net cash flow from operating activities, is the one true cash figure derived from your core business operations. It is the same number the direct method would have produced too. Okay, the entire indirect method is simply a logical, systematic way to move from the accrual-based net income to the true cash generated by your operations. Alright, we've completed the most analytically challenging section of the statement, cash flows from operating activities. Okay, we can now transition to the second major section, which is cash flows from investing activities. Okay, while the operating section focuses on a company's day-to-day operations and working capital management, okay, the investing section focuses on the management's long-term strategy for growth and capital expenditure. Okay, this section answers the crucial question: is the company adequately investing in new productive capacity to sustain future growth? We'll see that classifying these cash flows is much more straightforward as they track the acquisition and disposal of a firm's long-lived assets and non-operating investments. Alright, we're diving into the first core component of investing, which is plant, property and equipment, or PPE. Okay, we use the balance sheet account net PPE to reconcile the investing cash flows. The change in this single net account must be explained by three different things that happened during the period as shown in this slide. Okay. First, purchasing of new assets causes an investing outflow of cash. Okay. This is a deliberate strategic spending decision by management. Okay. Second, the sale or disposal of old assets generates an investing inflow of cash. Okay. And third, depreciation expense also affects the net PPE balance. However, this is a non-cash expense, which is why we added it back in the cash flow from operating activities section. Okay. When preparing the statement, we must find the individual cash amounts for the purchases, which is the outflow, and sales, which is the inflow, to report them separately in the investing activities section. Alright, this slide provides the mathematical formulas we use to reconcile the change in the net PPE balance when preparing the investing activities section. Okay, the top box shows the basic reconciliation. Okay, it starts with the beginning net PPE and adds purchases, which is our cash outflow. Okay, it then subtracts the book value of the sold assets and the depreciation expense to arrive at the ending net PPE balance. Okay, the book value of the sold assets is the number you would have to probably solve for if the cash sale amount was the missing piece. Okay, the bottom box shows the same reconciliation but written in terms of cash flow components. Okay, here instead of subtracting the book value of sold assets, okay, we subtract the cash sale proceeds, which is our investing inflow, adjusted for any gain or loss on sale. Okay, remember the cash sale plus or minus the gain loss is simply the book value of the asset. Okay, so both formulas are mathematically identical. These equations are essential because they allow us to use the depreciation expense and the change in the net PPE account to solve for any missing cash flow items. Okay, the purchases or outflow or the cash proceeds from sale, which is the inflow. Okay, which must be reported separately in the statement. All right, we are finishing the investing activities section by looking at the investments in securities. Okay, these investments include both short and long-term stocks and bonds of other companies. The accounting here is very straightforward. Okay, when a company makes a purchase of investment securities, cash is paid out, which is reported as an investing outflow. Okay, conversely, when a company receives cash from the sale or maturity of investment securities, it's recorded as an investing inflow. Okay, this section is crucial because it shows how a company is using its funds to earn returns or manage liquidity in its non-operating portfolio. Okay, all right, we've covered the first two sections and we can now move on to the final piece, which is cash flow from financing activities. Okay, this section tracks all cash flows related to external sources of financing for the enterprise. Okay, in other words, this shows the cash exchanges with our creditors or debt holders and our owners or stockholders. Okay, this section is vital for analysts because it reveals how management has chosen to fund the company's growth and what kind of capital structure the firm maintains. Okay, we will break down these exchanges into two categories, debt and equity. All right, we'll begin with exchanges with creditors or our debt holders. Okay, the first two lines are straightforward. Cash received from issuing new debt like notes, bonds or mortgages is a financing inflow. Okay, because it provides external capital. Okay, conversely, cash paid to repay the principal amount of that debt is a financing outflow. Okay, the last line is a crucial distinction under US GAAP. While interest payments are related to debt, they are usually classified as an operating activity under US GAAP. Okay, this is because the corresponding interest expense is reported on the income statement. Okay, however, be aware that IFRS allows alternative classifications. Okay, interest paid can be classified as either operating or financing. Interest received, on the other hand, can be classified as either operating or investing. Okay, this IFRS flexibility recognizes that interest received results from investing activities and interest paid is a payment to providers of financing. Okay, but it can be confusing to financial statement readers. Therefore, when we prepare the financing section under US GAAP, you must look at the change in debt principal and completely ignore the interest portion. Alright, we are concluding the financing section by looking at exchanges with owners or the shareholders. Okay, these activities affect the equity accounts on the balance sheet. Cash inflows here are generated by issuing new stock. Okay, whether common or preferred, it doesn't matter. This increases our contributed capital and is recorded as a financing inflow. The outflows, on the other hand, include repurchasing the company's own stock, which is recorded as treasury stock, and paying cash dividends to owners. Okay, remember that dividends are classified as financing outflows. They are a distribution of income to owners and are not reported on the income statement, distinguishing them from operating expenses. Okay, in the bottom of the slide, we see a reconciliation for the retained earnings account. Okay, this is important because change in retained earnings is explained by net income, okay, from operating activities, and dividends from our financing outflow. Okay, if the dividends paid amount isn't provided, you can use this formula to solve for it, right? Okay. All right, we're at the final slide now, bringing the entire statement of cash flows into focus. Okay, this is the finished product that summarizes all the work we've done in this session. The statement is a simple mathematical reconciliation. Okay, once you calculate the net cash flow from operating, investing, and financing activities, the sum of these three figures gives you the net increase or decrease in cash for that period. Okay, the final step is the most important one to check. When you add that net change to the cash at the beginning of the period, it must perfectly equal the cash at the end of the period, which is reported in the balance sheet. Okay, but what about non-cash investing and financing activities? These are significant transactions like acquiring equipment by issuing a long-term note payable that do not involve any cash. Okay, because they are important, they must be reported in a supplemental schedule or narrative outside of the three main sections. Okay, finally, companies must also provide supplemental disclosures for the cash paid as interest and the cash paid for income taxes. Okay, we have reached the end of this session. With the completion of this final statement structure, I hope that you have mastered all the components of the statement of cash flows. Thank you for watching this video. In our next and final session, session 12, we'll shift our focus to analyzing financial statements. Okay, concentrating primarily on using financial ratios to assess a company's performance, risk, and profitability. See you there. Cheers.